Chemutai Mungo, thank you so much for your time. Congrats on the F21 numbers. Let me start with the interest income, the little of a dip we're seeing there. What's happening? Because I can see your loan book has grown quite a bit.
What I would say is, yes, the volumes have grown. Margins continue to come down marginally. Of course, we invest in treasury bonds, treasury bills, and customer assets. The margins came down slowly, but not as fast as last year. They've stabilized. Of course, reacting to the interest rate environment. So that price margin impact. But we were very good at also managing our cost of funds on our deposits. If you look, our current accounts and savings products constitute 91% of our total deposits. So what really we continue providing our customers is more propositions, and obviously the wealth product, which is an off-balance sheet item, has also grown. And many of our customers have also taken some of their funds there.
All right.
So we think 2% reduction was fairly mitigated, and we as clients come forward also to borrow more volumes, we are very optimistic in 2022 that should bounce back. Okay.
Speaking about the optimism for 2022, and given the sort of horizon we are seeing going forward, how do you see yourselves playing when you look at the government securities vis-a-vis the private sector lending? Granted, we have an election ahead of us, and many are beginning to assume a very cautious stance. How do you see StanChart positioning itself?
For us, really, we'll continue having dialogue with our clients and supporting them. I mean, if our clients are not in need of products, then we will not be able to offtake our products. But we are very optimistic. I think traditionally people know in an election year, there is usually they slow down slightly, and I think people plan deliberately to execute early enough in the year. So we are hoping that volumes will continue picking up. And then, of course, after the elections.
I see. There is the overriding conversation right now around the risk pricing model. Some banks have told us, yes, we've received the green light from the market regulator. What can StanChart say as far as this is concerned?
What I would say is, obviously, we've had conversations with the regulator. We are at the tail end of that, and we are also expecting to get the green light.
In terms of your asset quality, how do you assess the way you closed FY21?
We came into 2021. It was really an uneven space, but much better than 2020. I think in 2020, the pandemic, the shutdowns were quite tough on business, on our business owners. But in 2021, that recovered. And of course, they were able to continue doing their business. And so we saw that the fundamentals shifted and improved substantively. And I think also the support that the banking sector and the regulator and the government did to, blunt the impact of the pandemic in 2020 had a really good impact in 2021. People were able to commence their operations faster. And so we see our portfolio has really, really improved. The fundamentals that we monitor are really looking up.
Okay. And looking at the way you have slashed costs, because I think looking at the numbers from a very high level, there's quite a tailwind from cost rationalization. Just how far do you think StanChart can push this cost trimming agenda? Because at some point you really ask yourself whether are they now then taking it to a bit of an extreme?
Remember, we are operating within a set cost base and reallocating it towards the areas that support our strategy. So, of course, our big strategies was to digitize and really provide world-class, platforms, be it in our corporate business, the straight-to-bank platform. We again reinvested in that and really have rolled out what we call a next gen. So we've really invested in the digital capabilities, at the same time keeping the cost flat. Of course, we've taken out some, what we would call costs that no longer really pivot too much towards the strategy, and we've really done very well towards that. So we continue really ensuring we are productive, and obviously with the investments that we've made, we want also those investments to be productive. So of course, when you look at the digital bank, we want to onboard more customers, and that's why we're confident that when we go out in our mass retail and really play in that space profitably, because the cost to serve customers will come down. So really, I think we will continue that discipline, obviously. Yeah.
Russia and Ukraine. Standard Chartered is a bank with a very wide footprint. And for those of us who are looking at the bank now are asking, are there, even if it is not Kenya direct, are there spillovers you're seeing from other avenues where you operate, which could impact your business?
I think we've learned, I think the pandemic, we've learned, how something can bring the globe on a standstill and just affect everybody. So I think there are lessons there. When you look, of course, at the geopolitical tension that is just being generated by that, I think analysts see cost of commodities, oil, etc., to go up, and that obviously, we tend to, as an oil importer, our inflation could go up. I see also analysts talking about food, that Russia and Ukraine really are a core component of the global supply chain for food. So those are the early indications. Obviously, as it unfolds, we are watching it very carefully and seeing how that plays out.
Okay. As we close, it's quite a dividend proposal coming from StanChart. We did anticipate a dividend, maybe not as much as we have seen in the results. Could you just give us the context around how you arrived at this? And I'm asking this question bearing in mind we have a potentially very uncertain environment in the coming months in the country.
So the way we look at returns versus capital to deploy, because obviously in banking we need capital to deploy so that we can do our business. So we have a very we have a mechanism, we call it our capital risk appetite, where of course in banking we also stress test through the internal capital adequacy process, or ICAP. We stress test and really measure the impact of shocks, and using that tool, we also feed it into our capital risk appetite. So we have a mechanism where we are able to keep a buffer for eventualities, and also keep some capital for growth for the future. And then really we don't intend to keep excess capital. We give it back to our investors. So yes, we are very proud that we were able to declare a dividend of 19 shillings per ordinary share, which is 81% increase year on year, and also about 81% payout of our total net earnings.
Around the SC Shilingi Fund, StanChart is venturing into this money market space at a time when many players in that space are becoming cautious. And the reason is because if you look at the collective investment scheme regulations, the market regulator has become very tight in terms of where you can play within the yield curve if you're in the money market. So your weighted average has to be 13 months. So you can only play in the short end. So yields are a bit squeezed. And many players are asking us, how will we justify a return? And I'm just curious, how do you assess the timing of going into that space?
We've obviously, we deliver most of our wealth products through partners. So we've partnered obviously with Sanlam, who is a key partner for us, even with our banker assurance products. So we're giving customers essentially choice, money market, mutual funds, treasury bills, treasury bonds. And I think customers will be able to use all those to help them diversify. Income also grew significantly because of driven by our wealth business, which is a key pillar for us through our affluent business. But even now we are also bringing the same propositions to our mass retail